Good morning and good afternoon, everyone. Thank you so much for joining us for 5 tips to maximize your multifamily financing, hosted by Arbor. I'm Sam Chandon, your moderator for today's webinar, Dean of NYU's Schack Institute and founder of Chandon Economics. And I am delighted to be joined by Carl Mastronardi, Multifamily Customer Account Manager at Fannie Mae, Bill O'Brien, Senior Vice President of Agency Production at Arbor, and John Richardson, Chief Underwriter for Agency Lending, also at Arbor. To kick us off this morning, I'm actually going to turn it over to Bill for a moment to tell us a little bit about Arbor, and then to Carl to tell us a little bit about Fannie Mae's multifamily business. Bill?
Thanks, Sam. Arbor is a leading national direct lender, a real estate investment trust that provides debt capital for multifamily and commercial real estate services. Arbor has extensive experience in both multifamily and residential mortgage origination, servicing, and has built a reputation for service, quality, and flexibility. Arbor has been a top 10 multifamily lender for Fannie Mae and a repeat top Fannie Mae small lender. In addition to Fannie Mae and Freddie Mac financing, Arbor also has CMBS, bridge, mezzanine, and preferred equity financing at its disposal. Arbor is an industry innovator that's invested in developing technology and streamlined loan origination and processing operations.
Great, thanks very much. Carl, can you tell us a little bit about Fannie Mae's multifamily business?
You betcha. For the last 31 years, we have been focused on our mission to provide stability, liquidity, and affordability in the housing market. We pride ourselves on being in every market every day, where we have loans in all 50 states. 2019 is going to be a milestone year for us, where we will have financed 10 million multifamily units. But I'd like to draw your attention to the acquisitions by area median income on the slide. The vast majority of the loans that we make are affordable to folks earning 100% or less of AMI. In fact, 50% are from 60 to 100%. Excuse me, 51% are from 60 to 100%, and roughly a third are at 60% or less of AMI. Our flagship program is the DUS program, the Delegated Underwriting and Servicing Program. Arbor is a leading partner in that space. That program allows the lender to underwrite, originate, and deliver loans on a delegated basis to maximize speed and flexibility. We are combined, Arbor and Fannie Mae, your partner for the life of the loan. And whoever originates the loan, in this case Arbor, services the loan. So there's no master or special servicer. And finally, we pride ourselves on our single asset MBS that allows us maximum flexibility in structuring debt.
Thanks very much, Carl. Just a couple of reminders for folks that are dialed in. Using the GoToMeeting feature set, you're actually able to send your questions right into us. And I see that a few have already come in. We'll be answering those as we go through the webinar. We'll answer some of them at the end during our Q&A period. And if we don't get to your question during today's call, we have a very large number of participants for today's session. If we don't get to your question, then someone from the team will be certain to follow up in the next couple of days to address it with you one-on-one. But please feel free to use that chat feature to share your questions with us as we're going through the material. I've got one of my eyes on the screen to see them as they come in. Another reminder for folks, in the coming days, keep an eye out. We'll be sending you links to both the replay and the slide deck for today's material, so you can review it at your leisure as well. In terms of an agenda for today's call, I'm going to spend a couple of minutes on a brief macroeconomic overview, tell you a little bit about what's going on in the U.S. economy, obviously sort of a lot of mixed signals that we're seeing, a little bit about what's happening in the U.S. multifamily market, but I'm very quickly going to turn it over to the team and the panelists to talk about the 5 tips. And so streamlined rate lock to lock in your interest rate early, small loans to help grow your portfolio. It's a small balance lending piece. Affordable and workforce housing loans to receive flexible financing, structured finance to execute larger multifamily deals, and green financing to lower operating expenses and increase property income. We'll take the last few minutes of today's call to answer as many questions as we can before we break. And again, we'll follow up with you in case we don't get to your question during today's call. So turning ahead to the macroeconomic overview, the first slide here shows the Wall Street Journal's economic survey. While I have my own particular views around what the economy will look like over the next couple of years, part of the reason that I like citing the Wall Street Journal survey is that they are surveying and getting input from a very large number of economists that are crossing the spectrum in terms of their views of how the economy works, but also ultimately, crossing the political spectrum. And I think what we see here is that, with folks with sometimes very divergent views on the way that the economy works, there is a general consensus. As compared to last year at this time, the outlook for the U.S. economy in 2019, as you can see, has been revised down from a 2.4% growth rate to 2.2%, and in 2020 is still at 1.8%. The important contextual point here is that economists really are telling us and signaling that they believe the economy is going to perform below its potential. How quickly can the economy grow in an environment of stable monetary policy and an environment of stable prices? And we generally think those numbers are a little bit higher than what we see here. Part of this reflects economists' concern about the longevity of the cycles. Where are we? And if you take a look at the next slide, what you can see is that as compared to any other expansion during the post-World War II period, the current expansion is actually the longest we've ever had. We've surpassed that 120-month record that had been set following the 2001 or leading up to the 2001 recession. So this is the longest expansion that we've had. Where that doesn't mean, and this is an important contextual point, that doesn't mean that the expansion needs to end. There's no finite or defined life around an expansion. But we are seeing some signals in the market, in the labor market, in the broader economy, some of it being the impact of, or the potential impact of deterioration in some trade relationships that we have in the United States and geopolitical risks emanating from other parts of the world. There are some downward pressures, and there is an expectation that the next couple of years could be a little bit tougher for us than the last several have been. The final contextual point on this, though, is that when we think about the possibility of a downturn, it's important to remember, and this most recent expansion is a case in point, downturns are relatively short-lived as compared to the periods of expansion that follow. Even the Great Recession, or the Great Financial Crisis, lasted for a relatively short period as compared to this very long period of expansion that has followed. So the key for us, I think, is going to be in anticipating and being well prepared for that downturn when it comes, so that we can come out on the other side and be thriving as we re-enter the marketplace and the market returns to growth. I'm going to jump ahead then. Made the point about sort of economists' expectations around the possibility of a decline to the slide on the employment market and what we see happening with labor. A couple of points here. The labor market has recovered nicely over the last couple of years. It has been slow going. As you can see from this slide, that very deep downturn where we lost 6.5% or so of the jobs in the United States, the very long period of time, the 76 months that it took us to come full circle and really recover jobs just on a count basis. A much longer recovery cycle than we've seen in the past. But in the last couple of years, the labor market has tightened considerably. We've actually started to see more meaningful upward pressure on wages in the last couple of years than we've seen for most of this expansion. And that's been an important point for us. Where we've not seen as many jobs created in recent months, part of what we attribute that to is not necessarily hesitancy on the part of the employers, but instead, what we see is that there are really more jobs open and available in the U.S. economy today than we've ever seen. The difference is that we hear from many firms that they're having trouble filling those jobs, that the skills required for the particular jobs that are available are not necessarily jobs that are easy to fill. Now, these are not just tech jobs. Interestingly enough, one of the sectors where there's considerable tightness in the labor market, there are not enough folks to meet the demand in the available positions, is in construction labor. And for those of us that are doing development and construction, we certainly have seen the impact that has had on wages and the cost of development and construction across commercial real estate property types. As a final point on the macro view, and again, I'm moving through it fairly quickly, happy to answer questions offline, moving it through it quickly so that we can get to these 5 key points. One of the impacts that we've seen is that although wages have started to rise at a faster clip, the difference between what's happened with rents in the United States in the multifamily space and wages has meant that really for almost 8 years now, the broad norm has been one where for the median American renter, their wages have not kept pace with rent growth. And that certainly presents a policy challenge, I think, for a lot of us on the call. It also presents a real opportunity to say, okay, where are the shortfalls in the availability of multifamily inventory around the United States, and for particular segments of the market like workforce or relatively smaller apartment buildings, what opportunities does that create for us to actually invest in and develop new inventory? What the data is really signaling to us is that there are segments of the market that remain undersupplied, in spite of the fact that we've seen a significant amount of new multifamily inventory come online in the United States. Well, with that, let's turn to the key tips. And Carl, I'm going to have you kick it off with tip number 1: streamlined rate lock to lock in your interest rate early.
Well, I think everybody has seen the market here recently jump around. Treasury rates go way down, they come back up. That ever-changing market can make it challenging for borrowers to navigate, especially if you're doing an acquisition, for example, and your unknown cost of capital may impact whether you can do the deal at all. So our recommendation is always, if the rate today works for you, lock it in. And with Fannie Mae, you can do that. There's a streamlined rate lock that allows our lending partners to rate lock the deal on a delegated basis for up to 180 days, longer as possible. There's no size limit. It's across product types and across financing executions. And I would open it up to JR or to Bill.
Yeah, I think the key there is to make sure that you're comfortable with the loan amount that you're going to close if it's an acquisition, so you've cleared the hurdles you need to clear, that the deal's going to go hard, or on a refinance that you're comfortable that you have your deliveries in to rate lock the deal. So we don't necessarily play the game of forecasting rate, but if you'd like the rate, we can certainly lock it at any time in the process.
So if I can ask both of you a question on that. We have a question from one of the participants in today's call that really does come back to this point. Person's asking, what are the incentives to rate lock right now if it doesn't look like rates are going to be going up anytime soon? How would you put some context around that?
I would just say, if you're a gambling man, roll the dice and take your chances. But if it works for you today, knowing that is, I think, a lot of peace of mind to borrowers. And it's like I said, especially in an acquisition environment, if you're buying something, if that cost of capital is key to your ability to ultimately close on that transaction, it would be a big risk, I think, to go down the road and potentially have rates go up, and then you're either not able to fulfill the purchase or have a whole different capital stack.
Yeah, just a quick administrative point. I see a couple of questions have come in about whether or not the webinar will be available after the fact. In the coming days, you'll receive a link to both the slides and a replay of the webinar, so you'll have access to both. Another question. Go ahead,
Sam. I'll just add to that. I think some folks look at it and look at where treasuries are going, and if rates are actually dropping, why would I want to lock rate? The flip side of that is spreads have widened out. So I would look at the all-in rate. So if you're comfortable with your 3.75 or 4% rate on your underwritten cash flow, I would lock in the rate that you look at. So the two do go together, and I think that's a key thing to look at.
Exactly. And, in volatile times like this, you have a 50 basis point run up in the rate that can totally kill your deal, whether it's an acquisition or a refinance. I think we actually really like to use this on refinances from a credit standpoint, just because, we have a very good look at the historical operations, generally for repeat sponsors, repeat clients of ours. That's where we feel most comfortable, but obviously also on acquisition transactions where you really need to lock in that rate today to hold the proceeds.
Yeah. The next question that's come in is, when folks are looking at a potential range of sources of financing, how would you describe the rates that folks are going to get through agency financing?
I would say very competitive, but I'll leave it to the guys who market multiple sources.
Yeah, I think, rates are still 3.75 to 4.25, depending on the leverage on the transaction, which is historically attractive and certainly competitive with what's out there in the marketplace. I think that's something to note. So again, is treasuries have dropped, spreads have widened, but if you focus on all-in rate between 4 and 4.25 on a full leverage deal, I think that's very attractive when you look at historical rates.
Yeah. Another sort of more technical question: what happens to the good faith deposit as folks move through the process?
So if they close on the loan, it's applied to the closing costs and whatnot. But if for some reason they have to break the rate lock, then they forfeit the deposit to compensate the investor.
Yeah, that might be a good point to actually, Carl, walk us through quickly the terms for SRL.
Sure. I think one more slide maybe? No. Oh, this is 2%. 2% rate lock for a term up to 90 days. 3% for a term between 90 and 180 days. You can find rate lock longer than 180 days. It becomes pricier, obviously, and I would say that it's also something that the lender will want to review, because if you're going that far out, obviously rates can change considerably.
Yeah. Well, you do have some wiggle room too, right? So you can have a 5% variance in the proceeds from when you lock rate to when you actually close without a penalty.
Correct.
And then if you're in between 5 and 10% off of the locked loan amount, you incur a penalty. If it's over 10%, you have to break it.
Yeah, it's a fairly minimal penalty from the 5 to 10%. After 10, then it's the entire good faith deposit.
So generally, I think we're sometimes a little more comfortable in the larger transactions, just because you do have a little more wiggle room on your NOI. You know, if you're doing a small loan, we have sold small loans, and we do sell small loans, but a lot of times that variance is pretty tight on a $2 million deal.
Yeah.
As a final point on the rate lock, if you take a look at the slide on the yield curve, just to give you a comparison, the Federal Reserve and the FOMC are really focused on that very, very short-term rate, and we know that over the last couple of years, their desire to either loosen or tighten monetary policy has not had a direct and one-for-one impact on the relatively longer end of the yield curve. And there are a variety of forces at play, but it is important to keep in mind that the Fed exerts considerable and effective control over the very, very short rate. The longer we go out on the yield curve, the more it looks like influence, and that influence does begin to diminish the longer we go out. What this slide shows is the yield curve that, of course, is front and center in a lot of people's discussion around the macro economy right now, because as you can see from this slide, depending on which day we're looking at it, it's flat to inverted. Between 16, 17, 18, you can see that in this case 1 month rate, coming up, considerably. But at the long end, the 10-year, things actually moving down, and so we have that slight inversion, which is a warning sign. A lot of people ask, does this mean we're going to have a recession? An inverted yield curve is not causally related to a recession. It's telling us something about market sentiment, market expectations, and so we have to understand that, which becomes important. Back then, finally, to that interest rate question, the folks have been watching the market the last couple of days. Even you've been able to see that rates, that there are some parts of the yield curve that have actually climbed up. The Fed had to inject significant liquidity over the last couple of days into the market, because they were bumping up on their target rate against the upper end or the upper bound of where they want to see short-term interest rates. So again, very difficult to predict volatility and movements in the interest rate market. But the last couple of days have been a good example of how rates have actually pushed up a little bit. So I'd be hesitant to place any real bets on rates necessarily remaining sort of as low as they are today. The next tip for today's call is small loans to help grow your portfolio. Carl?
We have some customers that focus solely on small loans. We have some customers that do both larger conventional loans or other property types and small loans. We consider small in the context of about $6 million or less with at least 5 units. So it can be pretty small. If you have a 5 or 6 unit property, or obviously it can be pretty large at $6 million. The advantages really are if you're doing a loan in that program, it's streamlined underwriting and closing lowers your closing costs. We do incentivize the interest rate in that area because it tends to be more middle market, smaller investor owners. So we like to incentivize that business to try to maintain that housing stock. We have a dedicated team at Fannie Mae that just does small loans, so with decades of experience. Our single asset MBS that I mentioned early on allows you to do yield maintenance or declining prepays, allows you to be more customized in your loan term, and you can do that in conventional, affordable properties, cooperatives, manufactured housing, and as always, you can do supplemental loans like all our product types.
Yeah. So you mentioned here sort of $6 million. What's the relevant range? Someone's actually asked what's the smallest loan that you would do through the small balance program?
It's really up to the individual lender how far they go. I have seen loans as low as $500,000, but it potentially could be a larger depending on what the Arbor's thoughts are.
Yeah. Well, it typically goes full recourse under $750,000. So that's a decent floor, but we have gone below that before.
Yeah. And Arbor has been a top small loan lender with both Fannie Mae and Freddie Mac and continue to be focused in this space. So, and I think the other thing to point out is 5 to 50 units also feeds both agencies' housing goals from FHFA. So I think that's another incentive for lenders, including Arbor.
Yeah. John, from an underwriting perspective, I think it's also important for folks to keep in mind that the small balance loan or the small asset in the multifamily space, it's not just that there are fewer units. It's not just that the valuation then is sort of scaled down, or that there's a specialized program. I think Carlos may come back to a little bit about why there's a dedicated team at Fannie Mae as well. The features and characteristics of relatively smaller properties are different from that very large, high-rise urban asset. Could you give us a little bit of a sense of what are some of the key differences when you're thinking about investing in a smaller asset?
I think for us, one of the challenges is diligence collection, just because you tend to deal with a different type of client on a 5 to 50 unit property than you would on, say, a 500 unit property. So there's a lot of paperwork that we need to get, a lot of historical data, and data that maybe clients aren't used to having to give. I think for a lot of our competitors in the space are banks, and a lot of times they offer short-term, maybe 3 or 5 year loans. I think one area where we're really competitive is in the longer-term fixed-rate space in small loans. So a lot of our business is 10, 12, 15, 20, 30-year term business where, smaller owners just want to lock up a great interest rate and hold the property for life.
And I think you made mention earlier on, John, sorry, I call him JR because I know him so well, that under $750,000 is recourse, whereas if you're doing $1 million multifamily property, it's pretty nice to be able to lock in 10-year long, fixed rate debt at attractive rates with only, carve-outs for bad boy acts. So non-recourse financing is, whereas with a bank you might have to sign recourse all the way up to, full.
Exactly. When there are folks who may be thinking about investing in the small balance market for the first time, perhaps they've been in a relatively larger multifamily market, and now they're looking at a sort of a non-primary or non-gateway metropolitan area. How much experience in small asset investing are you looking for when underwriting lending opportunities?
Well, we typically want clients to have at least 2 years experience owning a similar sized asset. Generally, we prefer local sponsors, people that are in the market where they're investing, where they're owning real estate. I'd say those are 2 of the key touchstones for us from a credit standpoint.
And we've got a flood of questions coming in on this. We've definitely got people's attention. In terms of the terms, if we could take a look at the terms at a glance, 2 specific questions that folks are asking here. What do LTV, debt service coverage requirements look like? And how would you put some context around that? And then is the program restricted to stabilized properties, or are you looking for a broader range of loans?
Yeah, it is restricted to stabilized properties. We generally, like properties that have been up and running for multiple years, the best case scenario, but we at a minimum need, trailing 3 months of stabilized operations. I think generally the program parameters are 80% leverage, 125 DSCR. Obviously, a lot of changes to those two numbers depending on where you are and what you're doing. If it's a cash out refinance, for example, that would be 75% LTV as opposed to the full 80 that we'd be able to do on an acquisition where there's cash equity in front of us.
We also see oftentimes on those coastal markets where cap rates are very low that the debt coverage is what dictates the maximum leverage. And so you may end up at a 125 debt coverage, but it might be something less than 70% LTV just because of the cap rate being, a very low number.
And we got one of our listeners asking if manufactured housing qualifies for the program, and I actually see that at the point on your terms. Small balance manufactured housing is eligible?
Absolutely. We really like the manufactured housing space, both in the small loan capacity, but or in their conventional flow business. So it's a great, affordable place for folks to live, and we do manufactured housing across the country.
So to close, Carl, if you were to hit on the highlights of the small balance lending program.
Yes. Streamlined documentation, number one. So the third-party reports can be streamlined by the lender. Speedy execution. We don't do a lot of loan document modifications. It's kind of what you see is what you get. Obviously, if there's something in a municipality or property specific that has to be covered, then we obviously will do that. But generally speaking, not a lot of loan document modifications, which cuts down on the cost and speeds the execution. Small good faith deposit of 1%, and the asset management not having to be as speedy with financial statements and whatnot.
And I think as you're looking for opportunities, clean, affordable, safe housing is what we're really looking for.
Absolutely.
Yeah. And on the Arbor side, can you guys just comment on there being a specific platform that you have available for folks that are looking for small balance loans?
Yeah, we similar to Fannie Mae, we have a dedicated small loan underwriting staff. And so, we've been a small loan player for over 20 years. So Arbor's got a deep history working with Fannie Mae on small loans, and now we're actually even doing more of them this year than ever before, thanks to the increase up to $6 million.
Great. So and you can take a look for that on the Arbor website. Keep an eye out for Alex. Tip number 3: affordable and workforce housing loans to receive flexible financing.
So our mission is to make and keep housing affordable, but despite all our efforts, folks in this room, folks outside of this room, we still have what I'm going to use my personal term of affordable housing crisis in this country, and that's not a Fannie Mae term, that's mine. We really need folks to have access to clean, affordable workforce housing, as Bill described. Our traditional affordable housing program has some specific requirements, around 20% of the units at 50% of the area median income, 40% of the units at 60% of area median income, maybe a project-based Section 8 HAP contract for at least 20% of the units, and 3 years or more rent restrictions going forward. The benefits of having those things are to try and encourage investment there. We allow up to 35-year amortization instead of a normal 25 or 30, and we allow down to a 120 debt coverage, which obviously helps proceeds. Both of those things help proceeds. And finally, favorable pricing on affordable properties. But we ask the question, what can we do? Can we do more? And we come up with a program that's just sort of a nuance of the affordable housing. It's called special public purpose. And this is a property that doesn't comply with the typical rent or income or occupancy restrictions required for a small property at multifamily affordable housing, but has other rent or income restrictions, can qualify for special public purpose, get preferential credit underwriting and pricing relief, similar to what a traditional capital letter A affordable property would have. It can be considered if it's got an affordability regulatory agreement that either is imposed by a government entity or contains some other rent and income restrictions. Has to have at least 20% of the units affordable at 80% of the AMI, and it needs to have some noteworthy special public purpose.
Could you give us an example of what you mean by that?
Sure, we've got a couple of cases. First one, it was a New York City 421A program. Tax exemption would be in effect for 25 years. Excuse me. The restriction obviously passes beyond the loan term. 20% of the units are restricted at 60% of AMI, obviously exceeding the 20% at 80% test. Leasing of these units was managed by a nonprofit under the supervision of the local housing authority, which we consider to be the third-party monitor, which is a key component to the program. And we were able to achieve a 120 debt coverage, which obviously, especially in New York, where, again, cap rates are low, debt coverage is going to be the most likely constraint of loan amount. So very happy that we were able to achieve a 120 debt coverage and help the proceeds in that transaction occur.
One of the things that we've got a couple of people actually asking, as we think about workforce and some of the innovations that we've seen in the shared economy over the last couple of years, one of them being in co-living, and that taking lots of different forms in different parts of the country, different properties. How are we underwriting, thinking about properties where some subset of the apartments may actually be set aside for short-term rentals?
It really depends. So if we're talking about short-term rentals in the Airbnb type of space, we take a look at that and say, that's not really a long-term rental. We really need to be at least 30 days, even if it's leased by a major corporation that's doing the Airbnb. We'd like to see the individual lease, the tenant that's using it, be there for 30 days or more. So that's something we generally shy away from. But as it relates to co-living, I personally haven't run into a property where folks are, rotating in and out of the units.
No, we haven't come across that.
And typically how we address, less than 5% of the units, if they're on shorter term leases, 30 days, we can accommodate. So we do look at that. And if there's some special circumstance, we're going to underwrite the deal to what it would look like on a 1-month rental if we got comfortable with the transaction, again, on a case-by-case basis.
Yeah, because you do see a lot in the 1 to 6 month space, right, in terms of lease terms. So anything under 6 months, I think, is a little unusual, but we do see a lot of 3 and 6 month leases.
Yeah. And I'll have one contextual point here. I think when we look at the multifamily inventory that's come online over the course of the cycle, it's tended to be overweighted towards the most urban locations. It's tended to be high-rise, very strongly or well-amenitized properties that, in a way that is only possible because of the scale. You've got a very large number of units. And most of the inventory that's come online has been in the top 1 or 2 deciles of the asking rent distribution. When we look at sort of where there's really a lot of unmet demand, and where some of that rent pressure is coming from right now, it does tend to be in assets that we think are designed and better suited to relatively more suburban locations, maybe relatively smaller properties. Their workforce in the sense of providing housing opportunities for teachers, firemen, policemen, folks who are serving the community. They might be in transit-oriented communities with good access to the public transportation infrastructure, in turn giving access to a wide range of employment opportunities. Sometimes because the properties are smaller, by virtue of that, there are fewer internal amenities to the property. So the units tend to be a little bit bigger themselves, but the number of shared amenities tend to be more limited. You're not going to necessarily have sort of a pool in a building where you're less likely to have a pool in a building with 10 or 20 units than one that has 200 units. Access to good quality public schooling is a feature that we see is very important in the workforce housing space. But again, we haven't seen, this is not an area where we've seen a huge increase in the inventory over the course of this cycle, and then part of the rent pressure, comes as a result of that. So, from as an academic with a policy perspective on some of this, these workforce housing programs, I think are particularly important in addressing sort of a real need in the market right now.
Agreed.
You have another case study for us in Austin, Texas.
Sure, yeah. In Austin, we were able to help an entity that was to support their larger desire to provide affordable housing in Austin. In this case, 51% of the units were restricted at 80% of AMI. The restriction was tied to the ownership structure. There's a ground lease involved with the housing authority, and so the housing authority was going to be actively involved in not in the day-to-day operations, but in just monitoring how the asset went. We've deemed that housing authority's ownership of the land is sufficient for the third-party monitoring, and we were able to do a 1.20 debt coverage again. So not a place where you normally would see a 1.20 debt coverage, Austin, Texas, but able to do it there, and very happy that we could.
I've got a note here. Now, we've got a number of questions in where folks are asking about the specific market or sub-market that they're invested in. Some of those we'll make sure to follow up offline. The one that's come in that's sort of broadly applicable, how do you guys weigh the experience and capabilities of the property manager when making a decision?
I'd say it's extremely important. Obviously we look at the owner, but the property management firm being qualified to handle whatever size and whatever type of asset is, that's an absolute key deal point from a credit standpoint, no question. We work with a lot of borrowers that self-manage their own properties, as long as they have a good track record and a good history of doing so successfully, we're fine with that. But we also work with clients who outsource and go through a third-party management firm, and if we get the name of that firm, we're doing a very deep dive into what they manage, particularly what they manage in the market, and what they manage is very similar to the project that we're working on.
And it's especially important when a borrower is coming in and looking to put money in and reposition the assets. So it could be a workforce housing deal. They're looking to put in $8,000 to $10,000 per unit in improvements and slightly increase rents while still remaining affordable versus newer product in the market. I think having property management companies that can manage through that process and transition is extremely important in the financing side.
Yeah. A bit of a technical question here, but it relates to sort of important issues potentially around tenant privacy. How do you confirm or verify that folks are meeting the income requirement thresholds when you're working with a borrower?
Well, typically, when they make their upfront application, the property management company collects how much money they're earning, mm-hmm. and if they qualify at that point, there's no really ongoing check to make sure that they maintain that income through the course of their stay at the property.
Right.
But the next tenant that comes in would obviously be checked again. So
the onus is really then on the property manager to make sure that folks are within the target income thresholds.
But once the loan's made, as long as initially it meets those requirements, we're not into the monitoring business.
Sure.
So the makeup of the property could change. It could become more affluent potentially. That's just something that maybe occurs naturally. It may not happen. It may go the other direction. So.
But you'll see the question come up during the due diligence process. So as a property owner, you'll see the lender reach out and ask those questions that if you're self-managing or if you have third-party management, that the property management company would supply based on the tenants being in place.
Yeah, and at Arbor, our underwriting staff, we inspect every single property refinance. And so we'll send an underwriter to the site and do a full interview of the property manager and also a lease file review to, basically dig through the files and make sure they're doing everything they say they're doing.
Well, tip number 4, at the other extreme, we've talked about small balance, so structure finance to execute larger multifamily deals.
Not going to be for everybody, but because we generally start at $100 million, we can go as low as 55 in some cases, and then go with the anticipation that that's going to build up relatively quickly. There's no maximum facility size, so you literally could have a credit facility of $1 billion, or if that was what you needed. They really offer, they're the Cadillac of the Fannie Mae programs because they offer the maximum flexibility by combining differing maturity tranches, fixed and variable components as the borrower would like. They can do additions, substitutions, borrow ups, all the property types, market rate, affordable, seniors housing, student housing. You can even do small properties of 5 to 50 units within a credit facility, manufactured housing communities, and military housing as well. It's attractive to folks because they can easily tap into the equity of their portfolio by quickly re-leveraging their credit facilities with a borrow up, or hold on to today's rates and avoid having to prepay just because they sell a property.
So a couple of questions have come in right away. The first is a number of people are interested in having you elaborate for a moment on whether or not and what conditions under which they could use structured financing for a portfolio of properties,
Okay.
And whether the individual properties in the portfolio would have a size threshold associated with them, or whether you're really looking for that total number.
It's really the total number. As I said, you can do 5 to 50 unit properties within them. You can do manufactured housing communities within credit facilities. So it's really the overall number. It's pool underwriting. So we're going to look at, we're going to run numbers on every property, but at the end of the day, the sizing, the tests, the debt coverage are all going to be based on the overall pool of assets, not just an individual asset. So, and then finally, important note is it would be cross-collateralized. So you really need to have common ownership structure across the assets. So, for example, if you have a large regional buyer who has just a handful of partners, that would be an opportune place for a credit facility. If you have a REIT or some other fund that is pooling assets and all common ownership, that would be an opportune place for a credit facility.
Yeah. Could you explain what you mean by borrow up?
Oh, it's similar to where we offer supplemental loans in the flow space. So after 24 or 36 months, you want to come in a flow loan and get some of your equity back out of the property that you've created. We allow supplemental loans at that time on generally all of our product types. In the credit facility space, a borrow up is advantageous because it, like a supplemental loan, allows you to pull additional equity out, but it also allows you to do it at first lien pricing and terms, which is a very attractive feature for that.
Speaking of pricing and terms, we've got another question here. Given that this is a little bit more complicated than some of the other product types that we've talked about, how do the costs compare to the borrower?
The costs for the individual borrower are generally a little higher because of the loan documentation costs up front. It's not cheap to set up, but once you've got it set up, it becomes pretty easy to add, subtract, multiply, and divide properties within the facility. JR, I don't know if you have any.
Yeah, I mean, I think it's a really great product for generally our larger borrowers who have medium to large size portfolios and are looking to recapitalize. I think you nailed it with the common ownership. That's one thing that sometimes makes a credit facility ineligible.
And there's a master credit facility agreement that's negotiated that Carl touched on. That's going to be the bulk of your negotiated cost on the legal side. And so if you're not, it really doesn't make sense if you're looking to do less than $55 million because the cost starts to offset the benefit. But I would point out, in addition to the ability to do fixed and floating rate debt within your portfolio, you can also ladder your maturities, so you can put in different term debt in place. So it creates a lot of flexibility, and you can buy and sell properties and move them out of the facility. So even if you're a seller of multifamily, we have a lot of borrowers that still use this product because they want to be active. So if you're active and you're looking to utilize a product and you have scale, meaning you have multiple deals and you have at least $100 million of needs, this is a really good product to look at.
Yeah, as Bill was saying, basically this laddering and staggering maturities, there's no debt associated with a specific property. It's relative to the pool. So you could have a fungible pool of debt that, say, has a 5-year, 7-year, 10-year, 12-year tranches. You can have a portion of it be fixed rate, a portion of it be adjustable rate. The adjustable rate portion is obviously easier to pay off if you want to downsize the facility. Borrow-ups, as we were talking about, akin to supplemental loans. The supplemental program in our flow space is generally limited to one supplemental loan during the term of the loan. We'd like it to be at least a 5-year loan. So if you do a 7-year loan, for example, and 2 years come in for a supplemental, you've really only got 5 years left. So that really only gives you a chance to do it once. But in the borrow up in the credit facility space, you can do as many as you'd like because your maturities may be staggered. You may have longer maturity component, and we're less concerned about that refi risk if you're looking at the entire pool of properties for your collateral.
Could you briefly walk us through the anatomy of a structured deal and just let us know a little bit about who's really a good fit for this product?
Sure. So the anatomy relative to structured deal, borrower finances initial acquisition with a couple of tranches of debt. They're probably not going to do just a single. If you're just doing a single term loan, it may not be advantageous. So they can come back in for a borrow up and release some of their trapped equity. If the portfolio has improved, they can come back in and add properties. Adding properties is relatively easy because they've got the existing master credit facility agreement, and just look at those and make sure that they aren't a detriment to the pool or hopefully an addition to the pool. You can release properties after you add a new one within 180 days, and you can sell several properties if you want. And if you've got a variable rate debt tranche in there, the prepayment is very low.
So, Carl, do you see most of the assets are in the same state or in the same MSA, or can they be scattered around the country?
We see both. So, yeah, that's a great question. We see, we obviously kind of prefer them to be scattered across the country if possible, because that gives us a little more credit diversification. But if it's all in one market, that's not a problem either. It's just, it could be just that borrower's niche, and they do a great job there. So if that's what they're doing, that's what we'll lean into.
Well, we have just enough time for tip number 5, green financing to lower operating expenses and increase income.
So our green and healthy financing targets loan production that meets positive, measurable impact, produces financial, social, and environmental benefits. The Green Rewards product is really around retrofits, renovations, and repairs to property, improving water-saving measures, improving energy use measures. Green building certifications are for existing properties that maybe were built to Energy Star standards or one of the other 17. We have a total of 18 programs that you can use for building certifications. Healthy Housing Rewards is a relatively new addition, and it's things that are done to really make the housing healthier for folks. It could be particular exercise facilities. It could be low volatile emissions of paints and things like that, I guess. But I want to highlight that we securitize green rewards and green building certifications as green MBS. So as those MBS are sold,
and that's mortgage-backed securities.
Yes, thank you. Mortgage-backed securities. We find that there are a pool of social conscious investors out there that would like to own mortgage-backed securities that are standing behind green financed properties.
When you have green rewards as the first item on the list, what are the most typical types of renovations and retrofits that you see?
Lower flow for water savings, lower flow shower heads, toilets, aerators on sinks. It could be doing things that replaces some of the infrastructure if there is something that's leaking or whatever. That would be more of a repair than it would be an upgrade. Then on the energy side, very easily, LED bulbs are pretty easy addition. I'd say, all the way from that to solar panels potentially, if you really want to get fancy, and that's a very attractive thing to do.
So it sounds like, there are some really easy ins for folks that, deploying something like a low-flow shower head or putting in LED light bulbs is something that, folks can really execute on quite easily to potentially take advantage of the program.
What we have found is that for the first part of 2019, the average cost per unit was about $466. The median cost per unit was about $400. And those improvements achieved a 30% savings, with at least 15% of that being in the energy savings component. So that's good for borrowers, it's good for landlords, it's good for the environment, and you can underwrite a portion of the projected savings. 75% of the owner projected savings and 25% of the tenant projected savings can be underwritten and used for increasing the loan amount.
So, and what I would add to that is there is a pricing incentive for that business as well, and as Carl just touched on, the potential for slight underwriting improvement that you can maximize dollars and coverage for the sizing of your debt.
Yeah, we've been very active in the green reward space. At Arbor, our focus is on workforce housing. A lot of our clients buy older vintage properties, and this is a great program for that. You put some money into the asset, reduce the expenses, you're going to get a better rate, and it's also better for the environment. So it's really a win-win-win.
And I think what you'll see is a lot of the 5 tips overlap. So you may have 5 to 50 units, you may have green, you may have workforce housing, and all of these things generate benefit back to the customer, back to the borrower in the form of what is the financing, what is the cost of the financing. So there's plenty of incentive from the agencies for that business, and that's what the mission housing is. And there's plenty of support from Arbor in providing that. So we have plenty of products to bring to you as it relates to that.
Yeah. Just a little bit more about the green building certification. And so that's a program where you said, list 18 different certifications that are recognized. Someone could go to one of the external accreditation authorities that designates buildings as being of a certain level of green,
right?
As opposed to necessarily Fannie Mae doing that certification itself.
Yeah, we do not do that certification. That is done by a third party. It could be LEED. The biggest one that comes to mind is the LEED certified platinum, LEED gold. There's Energy Star. We have a list of all 18 on our webpage that you can go look at if you'd like.
And you'll see that a lot of times when you're going for your permits or approvals, the local jurisdictions are requiring some of those green programs to be put in place by the developer. So this is an opportunity for the developer to benefit on the financing side.
Yeah, but you do have to actually have the certificate. If it's built to those standards, but you don't have the certificate, can't capitalize on it.
Yeah.
Another question coming in, I gather some folks have proactively taken advantage of the opportunity to make these types of investments, and as an effort to either be green or to reduce operating costs. They put in the LED bulbs. They've added low energy appliances. If I've already made the investments or some of the qualifying investments in my property, do I have options to take advantage of some of these programs?
If it's already done, it really needs to probably go be green building certified at that point, because we need you to be looking. When we make the green rewards loan, we would like you to be escrowing for it and completing those within 12 months.
That said, we have seen circumstances where that question has come up, where folks have spent money on, say, water savings, and now maybe they didn't address some of the energy savings, and so there might be some additional opportunities to still meet those needs. So we should at least have the conversation, and we're willing to work with you, and Fannie Mae certainly supports in the third-party engineers going out to do the work and see if it qualifies for green financing.
So it sounds like no matter where you are in the process, there's a product here, right? So it could be that on a prospective basis, you're planning to make the investments and you can take advantage of green rewards. Or if you're building, you've made investments and you may qualify for one of the certifications, then the Green Building Certification Program is something that you could potentially take advantage of. But in each case, of course, talk to the folks on the team to determine how best to proceed with that. Yeah. The healthy housing rewards, could you elaborate on that just a little bit for us before we close out?
Sure. It's obviously designed to reward health promoting design and provision of resident services and affordable properties. We will support that with lower interest rate. Typically, Fannie Mae pays for the certification of that, and its cost it can be from $750 to $6,000, but it's really about the health of the tenants. At the end of the day, we want happy, healthy, satisfied tenants that are living in an affordable property. That's our overall reaching goal.
Yeah. One more question before we close out today's webinar, and for all the folks that have submitted questions that we haven't gotten to, again, someone from the team will follow up to make sure we get those answered for you. What's the magnitude of the kinds of interest rate savings that folks might be eligible for when they take advantage of one of these green initiatives?
It varies depending on a couple of things. First and foremost, I think we're looking at how affordable is the property, because we want to make sure that we're supporting that part of the market. I've seen it be anywhere from, I'm just going to throw out some numbers I probably shouldn't, but 5 basis points to 35 basis points, depending on where we are in the market cycle and all that kind of thing.
Well, we've answered a lot of today's questions that have come in over the course of our hour, and we've just about run out of time. So for those that we didn't get to, again, we'll follow up one-on-one. Please do keep an eye out over the next couple of days. You'll receive a link to the slides as well as a replay of today's webinar. As a final point, do take a look at the Arbor chatter site on arbor.com. But my team partners with the folks at Arbor to produce a wide range of research reports on trends in the small balance space that really address a couple of different things, not only from an investment perspective, but what do the tenants look like in these properties? How are their needs different? What are the things that really support tenant retention in a smaller property? Because it can be in many cases quite distinct from and different from what we see in the very largest urban properties, as well as a broader multifamily market snapshot, a large loan report. So please do keep an eye out for those. In closing, I want to thank everyone who dialed in for today's call, and especially to our panelists, Carl Mastrognardi, Multifamily Customer Account Manager at Fannie Mae, Bill O'Brien, Senior Vice President for Agency Production at Arbor, and John Richardson, Chief Underwriter for Agency Lending at Arbor. Thanks, gentlemen, and thanks for everyone who joined us. Have a great day.